Okay, so in today's video, I'm going to be talking about the pros and the cons of a stock market crash, because we all know that if you're watching this video in March of 2020, then you have seen some major ups and some major downs, and mostly downs, which aren't really a good thing unless you've got a lot of cash in hand. But that's why we're going to be talking about the pros and cons so that we can talk about what's good and bad during a stock market crash. So we'll start by talking about all the pros, and then we'll move into the cons. That way we can keep everything separate and make sense of everything that I'm talking about. So one of the good things about a stock market crash is that typically you're used to a level up here, and that's what's normal to you in the stock market. But when there's a crash, everything comes down, and every single company within that new level is now on sale. So now all of the different companies that you've wanted to invest in, but maybe you just haven't, now they're considered on sale because they're not as expensive as they once were, or typically what you'd call overvalued stocks. Well, now you've got a bunch of stocks that were once overvalued way up here, and now they've come down to a new level that's more on the value side for you. So if you've always wanted to invest in a bunch of different companies, but you've just never done it, then when they go down, that's when you want to buy, because you always want to buy low, sell high. I know we've all heard that before, but it's true. You want to buy when they're a better value for you, especially if you're planning on keeping them for a long time. Now, you are going to need cash to do this, and I do not want you taking out debt in order to invest. I want you to take care of your debts first and then invest. That's always the advice that I'm going to give you. But if you have cash on the side, buying low is definitely when you want to be doing it. And then if you are going to start investing while the market's low, I would recommend using what's called dollar cost averaging. And basically this just means that you have a set amount of money that you invest over a set amount of time. So for example, if you had $10,000, don't just put that into the market tomorrow, spread it out over time. So for example, if you just wanted to put $2,000 in a month for 5 months, then do that. And that way you can average out in case it goes lower or higher, and then it's just safer for you overall. And then another good thing about a stock market crash is that if you own any companies that pay out dividends, dividends are always paid out on a per share level. And so when the stock market goes down, you can buy shares for a lot less money, and that way you can have more shares of those companies, and you're going to get paid out more in dividends because you have more shares. And so therefore the yield of your dividends is going to go up, and that's always a good thing, especially when you're buying low, because that's when the dividend yield is going up. And then if the dividend stuff is a little bit confusing, I did make another video specifically on dividend investing during a market crash. So check that out, and hopefully it should clarify a few of your questions. It does go over that a little bit more in detail. And then the last pro that I want to talk about during a stock market crash is just the fact that your overvalued stocks are now at a more normal level. And this is a good thing, because you never want to be buying assets that are overvalued. You always want to buy them at a normal level or a low level, because that's obviously what makes the most sense. So the example I always use of something that's overvalued is to use a common item that you're used to in your normal life. So right here, I've got this can of soda that you guys can see. Now let's pretend that we're all used to a can of soda costing 60 cents per can, okay? Now 60 cents per can is the normal level that we're all used to. Now if this was overvalued, it would be something like $1.20. And everybody would know that $1.20 was too much to be paying for a can of soda, because we just naturally know that. Therefore, we want this can of soda to come down to 60 cents or lower, maybe 40 or 50 cents. So then it's a better value in buying into it. And that's the way I express stocks, is because you want the stocks to be at a normal value, like a 50 cent level or a 60 cent level of where they're supposed to be, and not overvalued for something that's way too expensive for what you're getting. And so whenever there's a huge stock market correction or a stock market crash, all of the overvalued levels come down to a more value level, and that's exactly where they're supposed to be. You're supposed to be paying 60 cents per can, and then you're getting a good deal if it's 50 cents a can, but it's not a good deal if it's $1.20 a can, and that's kind of what's been happening. We've been living in an overvalued market, and now it's coming down to a normal level. Now, moving into the cons, the biggest one that I see with the stock market crash is just the fact that most of our investments are in retirement accounts. So that means that all of the money that we're saving up for retirement is getting obliterated whenever there's a huge correction or a huge drop. And I'm personally seeing it in my own life. Every single time I look up my 401k account, it just keeps getting worse and worse, and it is going to take a long time to recover, but that's okay, because I know that I have time for it to recover. The big problem is that if you're retiring tomorrow and you need that money, that is a huge pickle to be in, because you don't want to lose a bunch of money and then need it tomorrow, because you're not going to have enough time to recover. But if you have all the recovery time, it's not really that big of a deal. And then just keep in mind that if you are planning on retiring within the next 5 or 10 years, the wisest thing to do is to start moving your money into safer assets. So for example, if you have a bunch of money in the stock market right now, slowly start to move it as it recovers into bonds and money market accounts so that you're safer in case there's another problem. Because if there is a problem and your money's in a bunch of accounts that's not going to get hit hard, then it's not really going to affect you and you can pull that money out and you don't have to worry. And then if you do happen to be investing for your retirement and it's done automatically, then consider this a really good thing while the market's low, because like I said, this is dollar cost averaging. So for instance, if you have your paycheck deducted every 2 weeks and that goes into your retirement, then this is always going to be a fixed amount whether the market's high or low. And obviously when it's low right now, you're buying into those assets when they're a really good value. And that's good to be doing because you're at least helping it, even though everything seems to be hurting on the outside, because every time you look at your account, it's probably going down in value, but that's okay as long as you have time for it to go up. So just remember to keep those automatic payments going, whether the market's low or high, because you're using what's called dollar cost averaging, and this will be a good thing in the future as long as you have time to do it. Now, the con that bugs me the most about a stock market crash is the fact that if you start up here and you drop 30%, then you'd think that increasing 30% would get you back up to normal, but it doesn't. It's actually worse than that because you're starting at a lower point, and I'll explain how that works right here. So let's pretend that you have an investment account that's worth $1,000 and then it drops 40% and it goes all the way down to 600 bucks. Well, in order for 600 to go back up to 1,000, 40% isn't going to be enough because that would only be 240 bucks because you're starting down at 600. So what it's actually going to be is 67%, and that's a lot more than 40%, all because you dropped down to a new normal point. And that's the problem with the stock market crashing, is that you now have a new normal, and so in order to get back up to where you started, you need a higher percentage. And that actually gets worse the lower the drop. So if you have a higher percentage drop, like 30 to 40%, then that's going to be worse as far as the increase that you need to go in order to get it back up just to where you started. And sorry if that's kind of confusing, but just remember that when you start here and if you drop 20%, it doesn't take 20% to get you back to where you started. It's going to be higher than that because you're starting at a lower point there. Obviously, there's a lot more pros and cons when it comes to a stock market crash, but those are the ones that I specifically wanted to talk about in this video, so hopefully you'll learn something new. Now, if you just found this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So if you do have an interest in this type of content, feel free to subscribe. But for now, I'm just gonna leave a video right here that you guys can watch on the 3 best investing apps. So good luck out there, and thank you for watching.